Okay, let's jump right in. We're taking a deep dive today into Mansi's trading tip 33.
Right. It's a very specific options buying strategy for stocks.
Exactly. It's laid out, as one single tip. So, our mission really is to unpack it, see what it's about, what it might mean for you.
And what's interesting, I think, is how it offers this structured path, a way into a potentially complex strategy aiming for those big stock moves.
Yeah, it's quite streamlined. And for you, the learner listening in, this is maybe a more focused way to get your head around a specific technique. You avoid getting bogged down in loads of abstract theory.
Hmm.
So Mansi calls it a special option buying strategy. And, well, basically, it's a long straddle.
Which just means buying a call option and a put option. Same
Mhm.
stock, same expiry, same strike price.
Simple enough
Yeah,
definition
yeah.
and the goal.
Well, the goal with any long straddle is to profit if the stock makes a really big move. Doesn't matter if it rockets up or tanks.
Got it. Okay, so Mansi's tip gives us like actual steps. First step, find a stock.
Not just any stock, though. Needs to be near major support or resistance.
Right, key levels. And also look for high open interest or some kind of upcoming catalyst. Why start there? What's the thinking?
Well, if you think about it, a stock sitting at support or resistance, it's kind of at a decision point, isn't it?
Could bounce or break through?
Precisely. And high open interest, that just means lots of traders are already involved, lots of eyes, lots of money. It can amplify any move.
Okay. And the catalyst, like earnings.
Yeah, earnings, news, FDA decisions, something that could genuinely move the stock. It's the potential trigger.
Makes sense. Okay, step two then. The tip says buy the long straddle, aiming for about 45 days until expiration.
45 days.
And use strikes that are at the money, ATM, or maybe slightly out of the money, OTM, possibly using delta to guide that choice.
Right. The 45 days, it's generally seen as a decent balance. You get enough time to the expected move to hopefully happen without time decay eating away too much value too quickly.
Okay, avoids paying for too much time you don't need.
Exactly. And ATM or slightly OTM strikes, that's pretty standard for straddles. It's about balancing the cost of the options against how much they might pay out if you get that big move.
Yeah.
Delta just helps refine that strike choice based on how sensitive you want the option price to be to the stock's movement.
All right, now this next part seems really crucial. Mansi emphasizes waiting for confirmation.
Yeah, confirmation of the breakout. Don't just buy and hope.
And the confirmation comes from, let's see, price action, a surge in volume, and an indicator signal, like a MACD crossover. Why is that so important?
It's risk management, fundamentally. You're looking for proof, evidence that the move you anticipated is actually starting. Price breaking a level, volume confirming interest, an indicator like MACD crossing over,
Yeah.
using them together gives a stronger signal.
So you're not just betting on the setup, you're betting on the start of the move.
That's a good way to put it. Mansi specifically calls out these signals. Of course, other traders might use different indicators or combinations. There are always trade-offs.
True. Okay, let's talk exits. The tip says once you get that confirmation, exit 50% of the losing leg. That sounds a bit weird initially. Why cut the loser?
Yeah, it might seem counterintuitive, but think about it. If the stock breaks upwards strongly, your put option, the losing leg, is losing value fast.
Right.
By cutting half of that losing position, you immediately reduce your potential maximum loss on that side if the breakout stalls or reverses. You lock in a smaller loss on that portion.
Ah, okay. So you're reducing the drag from the losing side. The other half stays as a smaller hedge.
Exactly. It takes discipline, though. Cutting a looser when there's always that chance it could turn around.
Definitely. And for the winning leg, the one moving in your favor,
The suggestion is a trailing stop loss or perhaps rolling the option.
how do those help?
Well, a trailing stop automatically locks in profits as the price moves favorably, but keeps you in the trade if it keeps going. It trails behind the price.
Okay, protects profits
Yeah.
and rolling.
Rolling means closing the current winning option and opening a new one maybe further out in time, or at a different strike price that's now more advantageous to try and capture even more upside if you think the trend has legs.
Gotcha. Okay, let's try and recap Mansi's tip 33 quickly then.
Yeah.
Step one, find a stock near support resistance. Look for high open interest or a catalyst.
Step 2, buy a long straddle, about 45 days out, ATM or slightly OTM strikes.
Step three, wait for confirmation. Price, volume surge, MACD crossover, crucial step.
Step 4, on confirmation, exit 50% the losing leg. Cut that potential drag.
Step five, manage the winner. Use a trailing stop or consider rolling it.
That's pretty much it. And the so what for you, the listener? It's a defined process, isn't it? A method for trying to profit from big moves whichever way they go, but with a specific risk management rule built in with that losing leg exit.
Yeah, that structure is appealing.
Yeah.
So here's a final thought to chew on, maybe. The whole strategy kicks off by identifying major support resistance levels and upcoming catalysts.
The very first filter.
How much work is really involved there? How reliably can you actually find those setups? What does that research look like for you? It seems like the success hinges massively on getting that initial part right, even before you think about options.
That's a great point. The strategy execution is one thing, but the prep work, that's foundational. Definitely something to consider.